Okay, here's a bit of a headline that caught my eye this morning. You know I love the interesting, fascinating, mystical world of hedge funds, but apparently a bunch of international investors decided to put money into some bonds by a vehicle named Red Dragon. Okay, Red Dragon in and of itself should set off alarm bells, but that aside, these bonds were exchangeable into shares of food company CP Prima, a Thai-related company. All went wrong, or CP Prima, a Thai vehicle of an Indonesian company. Anyway, the rupiah kind of tumbled at one point last year, and everybody started to make deals on the sides to keep up their end of the bargain, to make the math work. Make a long story short, a lot of wheeling and dealing and more wheeling and dealing. CP Prima accused bondholders of trying to take over the company. The bondholders said, no, we don't really want to raise prawns, which is what CP Prima does. In the middle of this all, the prawns caught a virus and they are dying off. So they're not doing really, really well. So all these people were playing around with these credits, these bonds, and in the end, it's the prawns who took a bath. What does that have to do with hedge funds? Probably not a lot, but just to let you know that you do have alternative investments out there in this universe. Elsewhere, is this over-regulatory exuberance gone amok or just protecting the public? Europe is considering adopting rules that would require hedge fund managers based outside the EU to be approved before marketing to investors on the continent. The Alternative Investment Management Association, or AIMA, says that would be a grave mistake. Christoph Lee is the chairman and joins us here in Hong Kong. Hello, sir.
Hi, Bernie.
What exactly are the Europeans trying to do? So, somebody tells me this, they want you, if you're based outside Europe, to have to apply for a passport to market to investors on the continent. What?
That's right. And the passport is, for non-EU based managers, or who they call third countries, are effectively very difficult to obtain. So the net bottom line for non-EU based managers, and these apply not only to hedge fund, it applies to private equity, real estate funds, is that it will be very difficult for Asian managers to attract investments from EU investors.
What are they asking you to do? Are they asking you to achieve levels of disclosure that domestic European fund managers don't have to? Is there some discrimination involved here?
It's a long list. For example, it could include that the country has similar or acceptable supervisory or regulatory regime and equal market access for EU funds. Probably less of an issue for Hong Kong managers, as Hong Kong has higher standards, but in general there are other quirks in there that make it difficult for managers to comply with. And probably this was the result because there was very little consultation done with the industry, and it therefore assumes a structure that is out of sync with how things really are for our business.
Well, who would have trouble? If I remember correctly, at the G20, Hong Kong and Macau were left off the blacklist, so to speak. But I believe Singapore and a few other domains are actually, Labuan, for instance, Malaysia, are actually on a certain, I don't know what blacklist is. Would these be the domains that would have trouble meeting these requirements?
Actually, the implications are much wider. This has implications for anyone who's not in Europe. So this includes America, Asia, and even the Americans are now quietly lobbying the EU to redraft this directive.
But isn't this Europe just trying to protect its own people? I mean, it's not meant to be a fortress to keep out alternative investment managers, or is it?
It may not be the intent, but certainly the consequence is that it has a protectionist effect. It also affects people who are in Europe. It affects European investors, because if the draft goes through as in this current form, the net result for a European investor is that they have less choice, because there are less managers to invest in. The cost goes up, and therefore leading to diminishing returns. In fact, AIMA just came up with an estimate that this would cost pensions in Europe 25 billion euros a year if this goes through as it is.
Hurting the people.
Hurting the investors, hurting the pensions, who hurts the ordinary folks who put their monies and depend on the pension for savings.
All right. Dr. Ferris, you spent a lot of time in Europe. Do you think they're trying to build the fortress walls higher, or do they have a legitimate gripe here?
Actually, Christoph, this is what I wanted to raise and ask you. I think it is first a knee-jerk reaction to the credit crunch, to the extent that although there is no way in which one could connect whatever happened to the credit market, to hedge funds specifically, but it's a convenient whipping boy. And I think I'm not quite sure whether it is part of the process to be seen to be doing something. I mean, it is not accidental that all this comes now, and it didn't come in 02 or 03, or it didn't come in 2025. I mean, it is now in 08, 09. Obviously, it is related to the credit crash. But is there any potential link that you could actually say, hang on a minute, why us?
Yeah, I think you've hit the nail on the head. I think that's many people have made similar comments to what you just said. It also negates what other major reports have been found about the crisis. The conclusion was this is a banking crisis, not a hedge fund crisis. So we deal with the problem, deal with the banks. And we are pro-regulation. I mean, AIMA supports manager authorization and regulation. But we want it to be sensible, and we want it to be proportionate to we want a proportionate response to the crisis, not one that is overblown.
Because this is not going to help you at all, but I had, in fact, a comment saying this is as relevant as following Pearl Harbor, the Americans promptly attacked Mexico. And you say, hang on a minute. Following Pearl Harbor, the Americans immediately attacked Mexico.
Yeah. they didn't do that, did they?
No, precisely. But I said it is as relevant as that.
I thought I forgot something in high school history here.
Sorry, this was a little bit too abstruse. Okay, but there you go. Okay.
I'm just going to take 30 seconds here, and I'm going to launch an attack right here. A lot of people in the media, unfortunately, are a little bit blindsided by the whole term hedge funds, and it was tainted by a brush. You know, there are many of us you're truly not included, who took Bernie Madoff and turned that into a hedge fund issue, as if it was hedge funds that were the culprits in all that. You say you're for more regulation. How close are we there? 10, 20, 30% away from optimal, or what? Just want to get an idea about how much hands-on is okay and how much too much hands-on is going to be a death choke.
In many places, and I'll maybe talk about Hong Kong specifically, we actually have very sensible regulation. Managers need to get a license to operate a hedge fund here. SFC has very good rules to regulate our managers. So if you ask a local manager, I think we're already there. We've got it right. And the other thing I mentioned about local regulation is Hong Kong was one of the few places which did not ban short selling in the aftermath of the credit crisis last year, which in retrospect was the right move. You don't want a knee-jerk reaction. So it's that kind of approach, a sensible, measured approach, which AIMA supports.
All right. And the one thing we've learned, nobody is ever going to market anything ever in their lives called mini bonds again, thanks to Chris Topley here.